Hey, Archie, I've been getting a lot of calls from clients wanting to know if they should sell their stocks because the market is hitting new highs.
Well, Rob, let's evaluate the situation. I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to the Last Paycheck Podcast. We're your hosts, Archie Hoxton and Rob Hoxton. And today we're going to talk about stocks. Right? It seems like every time you open up your news app, especially your financial news app, you see, stocks hitting all-time highs. So the question we have today is, should we start thinking about selling stocks?
Yeah, it's not just what you see on the internet or in your news app or the Wall Street Journal. It's there. This is a question that I'm getting a lot. I don't know about you from your clients, but
all the time
I'm getting this question a lot. It's I see that stocks are at all-time highs. Should we be selling those stocks? And stocks. I mean, not all stocks are the same, right?
Right.
So some stocks are hitting all-time highs. Some are not even close. So the question remains, should I? I mean, isn't that what you buy stock for, is to hit all-time highs?
Yeah. It's interesting. When you say all-time highs, I hear that and I think, that's great. I mean, they're doing what they're supposed to do, right? Mm-hmm. You buy stocks so that they can become more and more and more and more valuable over time and hit. Of course, you'll get some up and down, but you want the all-time high. That means probably means your net worth is hitting an all-time high too. So,
yeah, and when they hit highs, at some point they'll hit a high and then they'll turn lower, and then you end up with a bear market, which is temporary,
right?
And move higher. You want to make sure that your investment strategy is one that is, designed not only for your tolerance for volatility or risk, but also it sort of fits the timeline of when you're going to need your money. But if you're buying stocks, you got to be okay with the ups and downs.
Right.
And just because they're hitting a new high doesn't mean that they won't continue to hit new highs, at least for the foreseeable future.
Right.
My view on stocks is you buy them and you hold them and you just keep them.
Yeah. Yeah. Because, market timing, and this is where you're trying to anticipate what they're going to do. Oh, they're hitting all-time highs. That means we're ripe for a downturn. But it doesn't necessarily mean that. So
here's what you should be doing, though. I mean, you should be rebalancing periodically. So if your target allocation is 60% of your portfolio to stocks and 40% to bonds, just making it really simple, and because of the run-up that we've had, in 2023 and early 2024, if you're at 65% stocks and 35% bonds, well, it might be time to, rebalance, take some profits. You're going to pay some taxes, but take some profits, reduce your allocation to stocks, and increase your allocation to the underrepresented asset classes like bonds.
Right. There are times to sell stocks, and that's one of them. If you're, it's time to harvest those gains and rebalance to what the right risk profile for you. Another might be if you're getting close to retirement and you haven't paid attention and your risk is way off. Say you're 100% stocks and you've retired a year ago. That might not be right. And that might mean it's probably time to sell some stocks, pare back your risk, and do your first ever potentially rebalance.
Right. Yeah, and so everybody's situation is different. I mean,
Yeah.
Some people may only own stocks in their portfolio because they feel like they can afford to weather that kind of volatility because they have a big pension plan and their income is guaranteed.
Yeah.
So I mean, every situation is different. Another situation that gosh, we're seeing a lot of right now, and having polite arguments with clients about. But there are a lot of people that own AI stocks, or stocks in companies that are benefiting from this AI, artificial intelligence craze that's going on right now. And some people have portfolios where a company like NVIDIA, for instance, might have been 5% of their overall portfolio, but now it's 50% of their overall portfolio. Mm-hmm. And at that level, their plan looks great. It's like, look how wealthy you are. You can afford to retire. But if something goes wrong, you have this concentrated risk. Now, that might be a place where you might say, okay, maybe we should take some of that off the table, take some profits, pay our taxes, and reposition the proceeds in other asset classes to diversify.
Right.
So that would be an example of where you might have an isolated incident or instance where, yeah, a stock seems to be really overvalued, and it's been a great run. Let's not be too greedy. I'm not saying sell the whole position, but maybe you should pare back,
right,
to reduce the risk.
And in that case, what you may be doing is you may be selling one stock and buying 100 or 500 stocks. So you're still benefiting from stock returns. So you're selling stocks, but you're selling a stock.
And let me say this: I might say sell a stock because it's too large a part of your overall portfolio. That is not me making a guess or an estimate of whether or not the stock is going to go up from here or down from here.
Yeah.
That is frankly immaterial. What it is you have this concentrated position which creates outsized risk exposure for you financially, and you need to do something about it. I'm not making some sort of prognostication about whether that stock's going to go up or down. So if I recommend that to you and you do it, don't get mad at me if the stock price continues to rise.
Yeah.
Right.
Yeah. I mean, because again, this is about, in that case, we're talking about risk management. We're not talking about, taking more risk to get the highest possible return. We're talking about, let's maintain high quality growth, but manage the risk. So that's a prime example of when to sell. And because we don't, maybe that stock is hitting an all-time high, and it may go on to hit much, much, much higher highs. You just don't want to be there if and when it hits its lows, because it might be lower than the rest of the market does. So again, this is, that's just diversification, not having too many eggs in one basket.
In 32 years of doing this, and managing other people's money along with my own, there have been some really dramatic examples of companies that were like going up, 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 up. Everybody thought that would continue forever until it didn't. Right. And some of them don't exist anymore. I'm not making any statement about any of the high-flying AI companies, whether they're going to exist in the future or not. I have no idea. But there are examples of, companies where like their employees had only the company stock in their 401k. Then the company gets in trouble for accounting fraud, and the company goes bankrupt, and those employees are now broke. They have to live on Social Security alone. So there are lots of, that company that I'm referring to was Enron. And, Enron was the darling. Everybody was trading the heck out of it, making a lot of money. And then they realized they were doing all these off-balance sheet accounting tricks to make their numbers look better. And they went from, $1 million in their 401k of Enron stock to nothing.
Yeah.
Almost overnight. So it is important to diversify. And there are some stocks that could be considered overpriced. But, if we look at bubbles in the past, like the tech bubble, for instance, and we compare that to the big tech companies that comprise most of the S&P 500's return, how does that compare historically?
Yeah. Well, and this actually opens up a conversation that's important to think about with stocks, because you've got the price of a stock, and then you've got the value of a stock. Now, the price is concrete, right? It's published your broker will update the price, and it's based on what other investors would pay you for it, basically every second of the day, if you were to sell it. And so that's something that you have a number. You know what other people.
It's
will pay
concrete,
for it.
although it's not immovable.
Right.
Right.
And it moves. But it's all based on what other people feel is, and institutions feel that it's worth. The other factor is value, what it's actually worth, and that's the thing that is it's up for debate, right? Because there's things like the actual assets that the company owns, there's the earnings of the company, there's the projected earnings of the company, everything that comprises a business, the intangibles. So you've got all these sort of subjective factors, and it's like, well, how much should you actually pay for that? And so that's much less concrete, but we have certain measures that we can use. They're little ratios. So, for example, the most popular, the one that you may be familiar with, is the price to earnings ratio. Essentially what that is how much you pay for every $1 that company earns. And so, you might see a price to earnings ratio of 20. That means you pay $20 for every dollar that company earns. And so you can use that to say, well, okay, how much should you really be paying for this company's earnings? Other ones are the price to book. You may see that. That has more to do with their tangible assets and how much you're paying relative to the value of those assets. So you can use these.
And sometimes you'll see price to earnings ratio. Then you'll see price to forward looking earnings ratio, 12 months, 24 months, 18 months. There are a lot of different ways that you'll see that term raised in the press.
Yeah. And that's more of a projection, right? But it can give you sort of a back of the napkin look at what people are paying for these companies. And so you look at bubbles, and a bubble generally tends to occur when the price of something gets really, really, really far removed from the value of it. And then the bubble pops, and the price, in theory, it snaps back to the value. Doesn't happen perfectly because, we're all human beings participating in the market, emotional, not always rational. But when you look at bubbles, those price to earnings ratios often get really, really, really far removed, much further removed than we see in the broader market right now. That doesn't mean that companies aren't necessarily overvalued right now. It's hard to say for sure, but they can get a lot more overvalued before the chickens come home to roost. So.
Yeah, I mean, if you're trying to time the market based on the price to earnings ratio, you can be wrong for a really long time before you're right and miss out on a lot of good.
There's an old saying, it's one of my favorite of the old Wall Street sayings, and I'm going to butcher it, but it's something like this. The market can stay wrong for longer than you can stay solvent. So
yeah, I remember that.
Yeah, so it's like you may think that the market is wrong and is pricing assets incorrectly, but it can be wrong for a pretty long time because we're talking about millions of participants, big institutional participants, trillions of dollars. And it can stay long for a pretty long time. So always keep that in mind. When you're investing and you're thinking, are things too hot? Is it overpriced?
Yeah, and when we think about wealth creation, and the word wealth is an obnoxious word, okay? I mean, when we think of wealth creation in our daily life, we're thinking about what, the millionaire next door, to use a term that's been kicked around for many years, but just people who have diligently saved in their 401ks and saved money outside of their 401k. They've got a house that's paid off. These are middle-class millionaires, and they are probably best served by not trying to time the market. I know 32 years of this and longer than that just with my own money. If I've learned one thing, it's that you can't time the market without relying on luck. Yeah. And luck is not a very good investment strategy.
Right.
So do the things, control the things you have control over. So if your portfolio gets overweight to one asset class or another, rebalance. Don't worry so much about whether or not one or two of your stocks seem to be overvalued at any or overpriced at any given time. Be broadly diversified and keep a long-term view with your long-term money.
Yeah.
Have that short-term money, right, available, but keep a long-term view when you're talking about stocks.
Yeah, absolutely. So just in short, there are reasons to sell stocks. You just laid them out, and there are reasons to maybe slow down and take your time and remember your long-term view. Everybody's got an opinion on this stuff, and so take that for granted. Stocks are supposed to hit new highs. We want that.
Greatest wealth creator and ever known to man has been the stock market.
Yeah.
Yep.
So we hope that this is helpful to you, and this gives you some insight to take into your own portfolio decisions. And anyway, we hope that you come back next time, subscribe, share, leave us a comment with a question if you have one. Happy to converse, and maybe it'll become an episode one day. And we'll see you next time. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.